flat. Nothing very much to go on with, but Nifty starting with 20 odd points, 24,900. Sensex is up 120 points, 81,350. Small cap index is, wow, it's up about 1.33%. Is that the actual rate? No, it's not. It's just changing now. 17,799. 17,800. Those are the first rates. Again, absolutely flat. And I think the small cap index will come up on your screen. The mid cap index, beg your pardon, which is also 0.15. So nothing at all. Nifty heat map should give you a sense of where most stocks are opening up on the index. And then we will move on with individual names. More down than up at this point in time. RIL is higher on one end. On the other end, you've got HCL Tech. Surabhi.
Okay. Let's take a look at what's going on. Actually, if it was not for Reliance, then the market could have seen a bit of red as well. Reliance with the news on Jio, the changes in their packs, and obviously the SEBI moves as well, which perhaps the market would want to believe it takes it a step closer towards that much anticipated Jio listing, 2% up on Reliance Industries. It has taken Bharti up along with it as well, 1% higher on Bharti. Let me just check Vodafone Idea. There was some commentary from Vodafone Idea as well on some AGR relief and what the next steps could be from the government's perspective. 2% up on Vodafone Idea. So telecom is looking good this morning. NTPC 1% higher. There's some gain on Adani Ports, about 1% or so. There's Hero Moto that's still continuing its good form from yesterday, 0.5% up. And then it starts getting really quiet. Tata Consumer, Trent, Titan, and Lever. Just some consumer names which are seeing a little bit of green, but not too much. On the downside, there is Axis Bank, Shriram Finance, Bajaj Finserv, Bajaj Finance, SBI Life. So basically, financials are not that hot this morning. And M&M is seeing some profit taking after its big run as well. 0.5% lower on Mahindra & Mahindra, but it's really Telecom and Reliance leading the charge today.
Well, that's right, Surabhi. And a couple of other stocks, Vedanta, they're going to be meeting going to be having a board meet to pay out dividend. The street likes that. That's the one that, in fact, is in focus. And that NCLT hearing as well is sometime during this week. So that's why that stock is up 1.5%. Reliance Industries, that's the big boy in there. Yes, it lost its way a little bit. Now it's gradually moving up. And that's the big gainer actually this morning. Bulk of the gains that we're seeing out of those 40 points are on account of Reliance Industries. But from the broader markets, stocks are doing a thing of their own. HLE Glasgow, they have announced acquisition of assets of Ameris, and the street likes it. That's one of the top volume gainers from the broader market. So HLE Glasgow should come up for you on the screen. The other one we're looking at is All-Time Plastics. There was a large trade. Manish Shukani bought closer around, a stake for closer around 10 crores. That's the other big mover this morning. That's up closer around 4.5%. I think it's a recent listing. You have Lakshmi Organics as well. That's moving higher on fairly good volume. So all those, the big movers in today's trading session. And Indocount, the other one that's moving very, very well, up 6% as we speak. That one, in fact, is flying away. And also keep an eye out on PG Electroplast. Yesterday, the stock saw a big run. There was some short covering that we saw. Now, it's on the verge, actually, of moving out of the F&O ban. I think either today or tomorrow, that's a strong possibility that that one comes out of the F&O ban if it continues with such strength. So that's the other one that I'm looking at today. In terms of losers, SML Isuzu has come in for some mild profit taking. That's down close to around 4%.
All right, I think we've got the sort of stocks opening up and down. Nothing, of course, like in terms of the sheer size of the moves, nothing like what we had yesterday. But 40 points is not bad after a 250-odd point bump that we have got in terms of trade. More stocks in a bit from now. But let's welcome in Rajiv Batra, who's head of Asia and co-head of Global Emerging Markets Equity Strategy, Chief India Equity Strategist at JP Morgan. Rajiv, good morning. Great to have you with us here. Thank you for your time. The question is about flows, Rajiv, and FII flows, for all the bluster sometimes that we get, do matter because locals have been big buyers, some $55 billion YTD. FIIs have sold about $13.5 billion YTD, and of course, we know what the market's done, right? Or not done. What are the 2 or 3 important determinants from here which will tell us or mark the return of foreign money in a sustainable way? Is it valuations? Is it something else? Rajiv, go on.
Thanks, Prashant. Thanks for having me over here. I'll say only one variable is important: growth. And I have said on your channel in past also, foreign investors are growth tourists. They invest in the destinations that offers them premium growth. Till India was offering them, India was all in favor. Now, even if I will say that, absolute sense, India valuations are expensive, but in a relative terms, looking at average valuations of India to emerging markets or other EM peer, we are well below the average ranks of that premium also. Still, people will not visit because the complaint will be that PEG ratio of country is still not around 2 or below 2 kind of a mark. So only one variable which is important is growth. And hence you can see in flows, if you take the passive guys out, because in 13 billion, close to 8 billion has come from the passive side in India, net inflow. Active guys have seen close to $21 billion kind of an outflow. So growth is a key ingredient for active foreign fund managers to make a comeback.
Okay, and what? So you're talking about earnings growth, Rajiv, right?
Yes. It will start with your high-frequency macro growth data points, which are your monthlies and weeklies, and then followed up with the earnings data print. We have a pretty good high single-digit earning growth for MSCI India for first quarter FY26, but that doesn't still bring India's PEG ratio to close to 2. So once we come around the territory of 2, that is around 12 to 13% earning growth kind of a criteria, it may satisfy my foreign investors' need.
Just one clarification, that flow number that you mentioned, could you just repeat that? I said $13.5 billion out of India from foreigners, and then you said passive and active.
Passive and active.
That was in the... Sorry, go on.
Yeah, the passive and active divide is net inflows in India through passive route is 8 billion, and net outflows are from active side is $21 billion.
Ah, okay, that's a big one, and that tells you a lot as well, right? That active managers have been going elsewhere, where perhaps earnings growth is higher, or maybe tactically, I mean, it's just a better play because of valuations. We know that, Rajiv. We've seen that South Korea has been a market well loved. There's been money going into China as well. The question is, when does it reverse? Now, you said 12 to 13% earnings growth. What is the visibility you have in the future? I mean, do you see that happening? We got a ratings upgrade from S&P. For instance, S&P is saying this whole US tariff business is not going to impact India too much. So when do you see us getting to 12 to 13% earnings growth?
So first of all, on the rating upgrade, market participants believe it is a belated one, but I'll say it is still it still signals a positive shift in perception of India economic strength and stability, which matters a lot from long-term perspective when you take into account borrowing cost and the risk premia for country. Remember, it has been declining from 4.5% a decade back to now almost 2.5%. It can slide down further from here and supports India valuations in future. Now, what could bolster the earning growth and GDP growth? I believe catalysts are getting unleashed one by one. Like, let's take into account monetary policy, which have been in complete drive. From November last year, we have seen cumulatively 100 basis point repo rate cut, 150 basis point CRR cut, and now fiscal has started giving full push. Remember, this is not just something new we have seen from fiscal side. Almost for a year, consumption has been getting boosted by fiscal measure, like first by subsidies, then followed by tax cut for middle class, and now this potential GST tweaks. So the twin policy tightening, which was in play in India till November last year, have now shifted towards safely to twin policy easing. So give it a quarter now from here, or max 2 quarters. Expect your double-digit 12 to 13% growth handle will appear on Indian equities.
Oh, okay, that sounds good. Just 1 to 2 quarters and we get back to double-digit growth. I think the bulls will love the sound of that, Nigel.
Well, that's right. Hi, Rajiv. Good to see you. Then what are the sectors that you're most bullish on? Because the globe is still a very sticky place, but it appears India is set to give up its underperformance. Last 1 year, we have underperformed. The earnings have been weak. Some domestic factors as well have been soft. Let's talk about the largest constituent. That's the banking names. What's your view out there? How do you approach it? There have been some kind of pressure in terms of asset quality. Credit growth as well has been soft, but the optimism is that we'll gradually see a pickup in credit growth. Your take, and what do you like from there?
No, so definitely when you are doing this much amount of an easing as per economic concept, what we have learned and what we have seen in the previous cycle also, that It may take 2 quarters, it may take 3 quarters, but usually credit growth start appearing post the start of the monetary policy cycle easing with this amount of a lag. Taking that into account, it will be unfair to assume that we will immediately go towards 18, 19% kind of an handle. Because remember, when the two big institutes got merged, at that point of time, the structural credit growth of the country brought down from 16.5 handle to 12.3%. So if we scale back to 11 to 12% kind of a zone also, it will be very healthy scenario overall. And remember, as I've said, the big part of India credit growth story for the last 5 years or maybe decade have been consumer. Because of excessive tightening, or you can say higher risk weightages and stuff, that particular zone start getting impacted. But now with the easing coming into the picture, even reductions in the risk weighted norms or provisionings also will try to spur up credit growth initially from that end. And once, because of that, consumption comes in picture, you will start seeing demand from corporate also, maybe led by working capital need or even by the capex related need. So it's kind of a cycle which got stopped, and maybe we are kick-starting the new cycle over here as such. But all in all, we are very gung-ho on financial space, and particularly private banks and non-banking financial companies.
Got that. Is there a way to make up, or actually let me ask you another way, for foreign investors that you advise, interact with, is this India, US, and what has happened there with regards to relations, etc., ever come up in conversations? In what way, shape and form? Obviously, this additional 25% tariff is not, even if it goes into effect from the 27th, it's not going to be permanent. I mean, it'll be negotiated lower. But does that come up, and in what way, Rajiv?
No, so most of the time, the geopolitical uncertainty comes off the investor's mind whenever it starts hitting the headline. But if you look from the last 20, 30 years perspective also, it has rarely derailed the long-term trajectory of Indian equity market. Usually this kind of a volatility ends up as an opportunity to accumulate the quality stocks. Now, the question that comes from investors are that how this equations will impact the growth. Now, I do agree, whether it's a political equation or a trade, along with the capital flows, interact with the growth from external demand perspective, because this external demand has been the key driver for India GDP growth from 2019 to 2024, rather than the private consumption. Now, suddenly, if this factor starts slowing down, you need extra growth boost coming from the other side, which is your domestic demand and private consumption. So till you don't see a resolution around the corner on that particular conversation, I think most of the burden for driving growth will be taken on the domestic end. But I do believe, like near term, we should not get too concerned about if this situation persists for longer, how we could be impacted. Yeah, number one will be the risk premium, which we have enjoyed due to the geopolitical diplomacy and got the risk premium of 2.5% from 4.5-5 territory. That can scale up back if the situation persists for a longer time, or the trade and the capital flows for country start getting impacted. But too early to say, because the situation is still evolving.
Rajiv, finally, from a thematic perspective of just building a portfolio for the next leg of the bull run, if I may say, I mean, if this is still a structural bull run in India, should that portfolio be more geared towards consumers? And this is a play both on obviously earnings and also valuations and tactical call. Should it be more geared towards a revival in consumption and therefore consumers? Or should it be more geared towards industrials and capex, which was the case? I mean, those were the earlier leaders of the previous cycle.
No, the thumb of the rule in emerging market is you invest as per what your policymakers are guiding you towards. So since February, we have seen the pivot has been made towards consumption side from capex. And right now we have seen, even with this GST tweaks, it will be more favorable for consumption. And rightly so needed, because as I've said, if external engines are slowing down, like JP Morgan estimate close to 1.6% GDP growth only in US. So even if the tariff concern resolve, external demand is not gung-ho overall. So taking that into account, domestic demand will be the play, and how you play the domestic demand, where maximum support you are getting your policymaker towards consumption side. So we pivoted towards consumption over capex in February last year, and we are still reiterating that. And the broad overarching theme, not just I will say within India, but emerging market with the global growth slowdown upon us, is domestic demand over exporters. So more you position your portfolio towards domestic demand like financials, staples, discretionary, real estate, hospitals, and maybe some of the material plays which are purely dependent on domestic demand, that will help you generate a high return and maybe even outperformance to your regional peers.
Okay, all right, Rajiv, we appreciate you joining in and giving us all of those details. All the best, and hopefully, as you said, things will recover from here on. Positive measures being taken both by the centre as well as the RBI, and those results will be seen in the coming quarters.
Thank you.
Well, let's move on then, and let's move on to JK Cement. We have with us Anuj Khandelwal, the business head, Grey Cement Division at JK Cement, who joins us on the show. The three big talking points that we'll be looking at in today's interview is that you have expansion that was announced in Rajasthan as well as Punjab, GST rationalization. What's the impact on cement, as well as how is cement pricing and demand shaping up? To answer all of that, we have Anuj with us. Hi, Anuj. Congratulations first. You know, JK Cement enjoys peak valuations, peak multiples, but earnings growth has been superb, volume growth has been superb, and now you're peppering the street with that 4,000 crore capex plan that you've announced. Break it up for us. How much of this capex plan will be via internal accruals, and what kind of debt will you be using to fund this?
So, Rajal, firstly, many thanks for having me on the show. Yes, we've announced an expansion in Rajasthan, where the integrated plant will be in the Jaisalmer sector, and there'll be two grinding units, one in Rajasthan and one in Punjab. Overall, the capex will be around 4,800 crores. 65% will be funded through debt, while 35% will be funded through internal accruals.
Got it. All right. And what does this mean in terms of the debt trajectory? As of last year, I think you ended consolidated debt was around 3,200 crores for the entity. With this capex plan, what is the peak level we are looking at in terms of capex?
So overall, look, you are right. The net debt last year hovered around 3,000 odd crores. Our estimates are that once the peak debt will reach to around 5,500 crores as a net debt. Right now, the ratio which we look at more closely is the net debt to EBITDA, because it tells us our ability to service the debt. Last year, it was around, we closed at 1.3 times of EBITDA. Even June quarter was around that number. Our internal target is that even at the peak levels, we should not, be much beyond 2. So around 1.8 to 2.2 is the sensitivity which we kind of look at. So peak debt levels of 5,500 crores, but net debt to EBITDA of around 1.8 to 2.2.
Okay, all right, got that. Now, with this capacity expansion, you'll be at around 39 million tons, approximately, with what all you have announced. But you have to get to around 50 million tons. So for that additional 11 million tons, where are you going to be looking at? Currently, I think most of your capacity is in North India, and that seems to be the focus area. For the remaining 11 million tons, any kind of geographic target you're looking at? A couple of big assets, Anuj, which are available in South India as well. Why don't you go ahead and just buy one of them? 5-8 million tons will come easily.
Look, I really enjoyed this conversation. See, look, we've grown from 20 million 2 years back to now with a visibility of around 39 millions by, let's say, mid of 2027. So that's a very, very steep kind of a journey. And, it's not just enough to put up plants. It's also important to monetize it. And our track record is good, but we want to maintain it. To your second question on where do we see the path from 39 to 50 million, there are many possibilities. One, we are looking at the South cluster, where we have a plant at North Karnataka, Muddapur. There in that cluster, we want to aim at around 5-6 million tons post the Jaisalmer expansion. And after that, we can again circle back to central India and try to put up another line. So, combination of that would get us to 50 million. But as I've always reiterated in my earlier conversations, we try to balance the need for growth and financial prudence. So as the things progress, we'll be announcing basis our financial situation.
All right, Anuj, for this particular capacity that you have announced of around 4,800 crores, a couple of brokerages have written, like, JM Financial, they are talking about a 10-year capital subsidy that you'll be entitled to. What is that amount over the next 10 years that you'll be entitled to? As per their estimates, it's around 1,000 crores. Would that be fair?
Look, I can't divulge the exact numbers, but just if I can give a breakdown, basically, any of the capital investments across the country, basically there are two types of subsidies. One is the capital subsidies, which you generally utilize for large investments. For example, in this case, Jaisalmer plant. And there is a SGST reimbursement incentive, which you generally utilize for relatively smaller investment, which is our two GUs in Rajasthan and Punjab. So capital subsidy, look, is a percentage of the effective capital investment, and it really depends on how much you are investing in and what area you are investing in. So there's a standard package by government of Rajasthan. I can't divulge the exact numbers as to how much will it yield to, because it's confidential, but suffice to say that combination of all the incentives can bolster our IRR by a couple of percentage points.
Okay, Anuj, what I was getting at is there any risk to this particular incentive? I ask this because everyone is celebrating that we're going to see some rationalization of GST rates. Now, as you said, SGST will be some part of that goes to the state as well. So effectively, if the GST comes down from 28% to 18%, then instead of 14%, the state will be getting 9%. Just, going by this example. In that case, does it put some kind of risk to the incentive you'll receive, the kind of leeway you'll get? Tell us your understanding, because everyone's celebrating the good part, but could this be a risk?
So we are also celebrating it because, look, GST rationalization has driven a lot of positive sentiment, and it will finally lead to a lower cost of consumption for our customers. In terms of risk, as far as the GST policy goes, look, on places where you have a capital subsidy, it really doesn't matter how much GST are you paying to the government, whether it's at 28% rate or 18%. It's basically a fixed amount of money which you get over a period of time, right? So it is not really dependent on GST rates being 28 or 18%. Places where, yes, there's a SGST reimbursement, what would happen is, theoretically speaking, if the rates come down from 28 to 18%, and of course we need to see the fine print, etc., basically the per ton incentive will reduce. But in most of the packages, there is an annual ceiling. So rather than meeting the annual ceiling, let's say by December or January, you might start hitting it by March, or might forego a little bit. So it's not a huge impact at any stretch of imagination per se to the subsidy income which can come to the companies.
All right. So you don't see this as a big risk. You rather celebrate the fact that the cost of constructing a house goes down. And in that case, it could help volumes and help demand on ground as well. Would that be the way to look at it?
Sentimentally, yes. But,
it's inelastic. Cement is inelastic.
Yes,
and
exactly.
as a cost of making a house, I'm reading a note today, it is just around 1%, less than that as well. So it's a more sentimental positive. Is that correct?
It's a sentimental positive. Can help infrastructure sectors a bit more. But on the housing sectors, just look, if a person has decided to make a house, he will make a house. Not really, a little bit of GST rationalization on cement will not change the decision that much. But yes, from an infrastructure projects perspective, it can lead to a significant cost reduction. So overall, I understand that cement is slightly inelastic, but sentimentally is a good positive for us.
All right. And if you could tell us about incentives on an annual basis, what is the rough incentive that you receive, if you have that number handy, as a company, JK Cement?
So look, I don't want to get into specifics. I think, it's a good number, but I don't want to get into specifics.
All right. The short point is just saying there's no risk to the capital subsidy that you get as well. As you're saying, it's assured by the state government. Got that. Good to see volume growth. You outpaced the industry. 15% grey cement volume growth came out of nowhere. And from there on itself, the stock has started its big rally. What's the view for the year? What kind of volume number do you end this year with? And you'll definitely be gaining market share because, the industry grew at around 7% at best. Your volumes grew at 15%. So target for this year.
Yes, Q1 was good. Industry, I guess, grew by 5-6% and we grew by 15%. But look, a lot of our growth came in central India, where our capacities are still new. So we were able to gain a lot of market share in central India. In North India, the growth wasn't that much, but the new expansions will solve for it. Overall, the full year picture which we are looking at, we are really targeting the magical number of 20 million tons of sales this year, which will be around 13% odd growth versus the last year. This is with the assumption that the industry will grow by, let's say, 6-7%.
Okay, all right. Final question then, with regard to your cost-saving measures, you all have been guiding for, I think, 150 to 200 rupees, cost saving. For this year, how much of that will be achieved?
So I think we'll easily achieve half of it. Quite a bit of it is already, I think, in the pocket. Around 50 odd rupees, I would say, would already have been realized. Maybe 30-40 rupees more. We have many initiatives coming up in the later part of the year, whether it is on renewable power, on AFR, and the likes. Even in the medium term, we have other cost-saving initiatives also lined up. In my previous interview, I also said we have secured a coal mine in Madhya Pradesh, which will get, let's say, operational in 2.5-3 years' time. And when that happens, the cost of coal will reduce for us for our central plants, where we are becoming much more prominent. So cost saving is a perennial journey, but we are tracking well. And we are on the target to achieve the numbers committed.
All right, Anuj, good speaking to you. Thanks a lot for joining in. You're quite gung-ho about this new capacity expansion. As you said, there is a capital subsidy. There's a bit of a cushion with regard to the state GST as well. And for the year, you're looking at around 20 million tons in terms of capacity. Thanks a lot for joining in. Wishing you and the team all the best in the time to come. Okay, all right. Well, let's move on to our next management. We have Endurance Technologies that reported a healthy set of numbers in the first quarter in a tough environment, actually. The revenues are up by close to around 18%. The profit as well was up close to 11%. We have with us Mr. Rajagopal Sastry, the Group CFO, who joins us. Hi, sir. Good morning. Thanks a lot for joining in. First, tell us about this GST rationalization. How it's going to help your business, because you'll have a dual impact, right? There's the ABS as well that comes into play. So for that, your company is required. And if sentiment improves on the whole, then inventory gets cleared out, and that's good for your volumes. So first, comment on that.
Good morning, and thanks for having me with you. GST definitely will be a very big positive overall on the economy, because it will increase the demand. And looking at our own scenario, yes, we will have an impetus on the demand because of the GST, because the vehicles are going to get cheaper. Albeit there would be a lull till the announcements are made and the demand really kicks in, factoring in the new change in the GST rates. What we are also seeing is that our stated objective of growth in aftermarket will also get a shot in the arm, because this will augur well for the organized sector. So overall, for this announcement, while we are waiting for the fine print, while we are waiting for how it will actually pan out and how will be the response of the market for that, our initial thought is that it's a very positive for us.
Mr. Sastry, hi, morning, sir. So right now, I think there are two different slabs, two different rates, 18 and 28%, depending on which component we're talking about. Most of the products that you make, are they in 28% or 18?
Yeah, we do use the 8708 or the chapter for the automotive, and our output is all at 28%.
Okay, so that should move down to, as is being discussed, perhaps that comes down to 18%. I mean, since you're part of the chain, you're claiming the input tax credit as well. Materially, on the P&L, will this cut make any difference?
On the P&L, it should not make any cut. It will only do good to us if there is an uptick in the volumes. And like we said, it should give a good benefit in the aftermarket sales, because that is always profit accretive for us. And if that boosts aftermarket demand, and that will be good for us.
Yeah, okay, got that point. Sir, you've had a good quarter, pretty decent growth, 11% growth coming in. And, Europe is a big geography for you. I think you get almost 30% of your business from Europe. So let's just go there. I mean, what are the conversations you've been hearing over the last 3-4 months with so much happening in the tariff world? Is there some additional opportunity? Would perhaps some of your European customers look to source more from you vis-a-vis the US? I mean, I'm just trying to understand if this whole tariff storm if it has any real implication for the business?
Both our Indian operations and the European operations, we generally produce for the local market. So there is no export from exports of our products into US, and there is no exports from India also into US. So we are very much local for local. In terms of the impact of the tariff, yes, it did have certain amount of uncertainty in the OEMs of the Europe. But these demand drop of over, they grew 1.6% in this quarter in terms of the overall sales. However, what you would notice is that this uncertainty in the demand in the OEMs has been for quite some time now because of the transition from ICE to electric vehicles and the latest tariff related discussions. But what we see is that all these difficult situations will have to find an equilibrium, and soon there would be growth back in the European sector, because overall it's a strong market any which way, both from a technology perspective and the demand perspective. And coming to our own performance, we have been acquiring capacities and we have been putting in capacities. We have been very careful in not to add to our costs, which are permanent in nature. And overall, close to 320 million euros of orders we had acquired in the past 4 or 5 years. All these are also helping us to see that our growth is intact. And we are also carefully looking at acquiring companies which are in good health, which are accretive to our margin, which are also synergistic to what our business, like it would be seen in the recent acquisition of Sectoral, which gave us capabilities and also profitability. So overall, our story so far has been good, and our plans for the future as we go forward is also very strong.
No, got that. You know, how big is this ABS and two-wheeler opportunity that you're estimating? I think the government has proposed new safety requirements mandating 100% use of ABS for greater than 50cc ICE two-wheelers and all two-wheeler EVs. Can you talk about what's happening there? Any orders you've got in this regard?
Yes. This is a very important move. I mean, first, primarily, we congratulate that the road safety is being given more importance, and an anti-lock braking system is extremely important element of two-wheelers to promote road safety. If you look at numbers, last year, the country had 2.38 crores of two-wheelers produced, out of which roughly around 30% had ABS. Now, this 2.38 also had the exports, but those are small numbers. If you remove the export numbers, the entire market of, let us say, assume 2 crores would be ABS. And that's a significant market growth of 5 to 6 times. Given in that sense that we were already available there in that anti-lock braking system, so we did have capacities which we announced of about 6.4 lakh anti-lock braking systems per annum, out of which we were producing something like 4.8 lakh. And our aim is that with all the preparations which I have been doing in the past few years, with our own test track, with enhancing our R&D capabilities, both in terms of talent and also homogenizing the technology which we had acquired from our overseas partners. So we are ready for a significant growth in the anti-lock braking system. What's interesting is that we do have the technology, we have the people, we have the R&D capabilities, and we are in discussions with all the OEMs. In the past few years, the quality of growth of the company has been very good in that we were growing across all the OEMs and across all the product segments, which is giving us a good entry point and being a partner of choice for the OEMs to implement ABS into their vehicles. And this is auguring well for us. And what is also important is that it's not only the anti-lock braking system, which they will also see a growth in the braking per se. So we need hydraulic disc brake systems to be easily able to applicate anti-lock braking systems. And that means our demand, the demand for disc brakes and the hydraulic braking systems is also likely to go up, and for which we have been preparing right from acquiring land banks so that we can put up factories. And we also have been setting aside capital so that we are able to invest, and that those actions are already in place. And we are seeing that this is a big positive for us.
We'll leave it there, sir. Good getting that perspective. Very, very useful. Appreciate you joining us here on the channel this morning. And good luck with your plans as you execute. I just want to take a quick look at what the market is doing and some individual names. Guess what the number one volume-led gainer is now on the NSE? It's Ola Electric. Ola is up 6%, 43, 44 rupees, and very large volumes at this point in time. There is Vari Energy, which is up about 3%. 3080 has got very large volumes, number two in terms of volumes. There is Inox Wind, which is up 4.5%. Stocks at about 146. There is Bellrise, which is up 4.5%. Recent listing, stocks at 146 rupees there as well. Actually, yeah. HLE Glass, I think we highlighted this in the morning. 16% on HLE Glass. 483 on humongous volumes, actually, for a stock like that. So HLE Glass Court is coming up. Denta, D-E-N-T-A, 14%. So 391 on that one. There is, which is looking very good. And, we highlighted this stock, all-time plastic. It started higher and it's up 7%. An influential investor picking up stake. And this one is up 6%, started, I think, about 3-4% higher, 310 at this stage. So there is lots of stuff which is coming through and volumes are picking up in right earnest now. We'll take a quick commercial break here. We'll talk to a company from the renewable space, from the solar space specifically. Vikram Solar is going to be talking to us about their upcoming IPO. The issue, of course, open for subscription today. Yanesh Chaudhary, CMD of the company, on the other side. Welcome back. One of India's largest solar photovoltaic module manufacturers is Vikram Solar, and they're coming to the market with a 2,100 crore rupee IPO. It's open for subscription today. In this segment, we will focus on three main points with the management, which will be with us in just a bit from now. Have solar gear makers reached the peak of their returns and margins? That's point number one. It's a question we've asked for already listed companies as well. Second, what is the impact of the ALMM scheme, which aims to boost local manufacturing, and what it spells for the business? Number three, finally, we will also try to understand the company's expansion plans. So let's get straight into it. Yanesh Chaudhary is Chairman and Managing Director at Vikram Solar. He's with us. Mr. Chaudhary, great to have you with us here. Thank you very much for your time. Prashant, this side. Almost 97, 98% of your revenue comes from solar PV modules, right? And about 80% of that comes from just 5 customers. So give us a sense of, concentration risk here, Mr. Chaudhary. That is one. Second is the number one issue that I highlighted. Are we at the peak here? Because the worry across the board for companies like you, and we already have a few listed, is that in about 2 years' time, the supply is going to overwhelm demand here in India with the amount of capacities which are being set up. So let's just start there with your perspective, Mr. Chaudhary. Go on.
Hello, Prashant, and thank you for having me. I'll first talk about the sector and how the technology has evolved over the years and why that is the most significant game changer for the solar sector. We started with a 200-watt solar panel. Today we are at a 600-watt in the last 10 years. So the overall form factor is much more efficient over the years. And not all companies are able to make use of this technology and ensure that they are producing and manufacturing at scale. Vikram Solar has been in the sector for the last 2 decades, and we are able to leverage the power of high efficiency and technology to deliver products. Now, as far as your question on overcapacity is concerned, I think the market, we are sitting at the tip of the iceberg. If you see the way this space has grown exponentially, I think it's still that much more or even more growth is expected to happen over the next 2-3 decades continuing. India is a developing country. We know that every year we need to add 3 to 4, 5% of new energy in the grid, considering the demand cycles, as well as not much is getting added from the fossil fuel side. So renewable is the answer, and within renewable, solar expects to gain large volumes, considering the depth and the.
No, Ganesh, no one's taking away from the use of solar and the use of renewables anyway. What we are trying to understand from you is your sense of whether a year or two. First of all, how long will it take for your capacities to come on stream? Because the objects of this issue are to put up fresh capacity as well as expand current capacity. I think you're doubling your current capacity as well. How long will it take for your capex to come on stream? And by that time, is there not a risk of maybe some sort of, if not a glut, but definitely an oversupply in the market?
So first of all, our capacities, we are currently at 4.5 gigawatt. By the end of this fiscal, we will be at 15.5 cumulative gigawatt. So we are adding significant capacity out of this fundraise. We will go backward into cell manufacturing capacity next year. So that will be another significant deployment of capital for that. Now, as far as the glut situation is concerned, the point I was trying to make was this is a technology space, and not every manufacturer, every player is able to leverage the power of this technology, considering that there is a lot of evolution that has happened over the years. And going forward, the large IPPs and the producers and the utilities will only need a certain level of efficient products which have bankability as well as stability, because a solar panel has to last on the field for 25 plus years. So this itself is a very big ask, and only so many companies are able to deliver that with a lot of credibility and legacy in place. So Vikram Solar has been in the space, as I said, for 2 decades. We are in the position to cater to this market in the most significant way.
No, I'm just quoting some numbers, Ganesh. Correct me if I'm wrong. I mean, these are from various research sources.
Yeah.
Last year, we added record, solar capacity. I think it was almost 23, almost 24 gigawatts was added, which was a record for the year.
Correct.
So again, how long will it take for your capacity to come on stream? Does it take a year? Does it take more than 2 years? And what is the current demand-supply gap? And where do you expect it to be? I mean, what is the projected, demand by the time your capacities go on stream?
Great question. I'm sorry. Great question. I think when we talk about... I'm sorry.
Yeah, go on.
When you say 23 gigawatt that has been added last year, that is AC capacity. So when you talk about in solar panel terms, you have to add 1.5 times to that. So overall, last year we added around 35 gigawatt of solar panels. And this year, already the run rate shows 40 AC. So that's about 50 gigawatts of DC capacity being added. Now, within this, if you see the overall ALMM listed capacity on MNRE projections, we have about 76-80 gigawatt available in India. And out of that, if you look at the capacity utilization factor, that you bring that down to another 40%, and then technology, you bring that down to another certain percent. So the overall percentage of high quality latest technology product that is available comes down to a bare 20% of this capacity that is published on the MNRE.
We have 2 more questions. I'm sorry to press on this, right? But that's the number one question on the minds of investors as well. By F5 27, The number that I have is domestic supply will be about 75 gigawatts per year.
Correct.
Against a likely demand of between 35 to 40 gigawatts per year.
Yes.
And hence that question that we are pressing again.
So
yeah.
this is nameplate capacity, and nameplate capacity is usually based on the highest efficiency and the full 100% capacity utilization. So where we in a general sense in the industry is to reduce that to an available and operating capacity, which comes down to 60%. So this 75 gigawatt, 60% of that is the available capacity. And from there, we talk about technology. So there is monoperc, there is multicrystalline, there is polycrystalline, there is TopCon. TopCon,
Sure.
which is the highest efficiency, which is further reduced in terms of available capacity, which is the desired product by all IPPs.
Okay, Ganesh, must say you've put up a great defense. We've been grilling you on just one point about possibility of overcapacity, but obviously, I mean, you have your ear close to the ground. Very quickly, just on the operations as well, the company saw about a 35-36% growth from the previous fiscal to FY25. You're working, I mean, you were at almost 16% margin. Last year, you closed at about 14.5%. Steady state when all this capacity is on stream. I mean, your current margins, are they the sustainable range? Could it be lower, higher? I know you can't talk too much numbers, but give us some sense on the sort of model that you're looking to build.
I will try to refrain from talking about forward-looking numbers, and I hope you understand that. However, the way we see this market evolving is that there's going to be a lot more domestic content requirement going forward. We already see that there is, Chinese dumping has come to a grinding halt because of the basic custom duty as well as the ALMM. And going forward, we see this continuing. While the market is expanding, the way domestic content is being not just favored but mandated. The government ALMM list 2, which ensures that the cell that goes into the solar panel is also domestic, and hence our grand expansion of 12 gigawatt in solar cell. So from next year onwards, we hope to stabilize our margins at the levels that we are today, probably look at some improvements, but that remains to be seen.
All right, Ganesh, we hope to speak to you soon again on the day of listing. Thank you for joining us. Good luck with the issue and appreciate you coming on here on CNBC-TV18. Thanks indeed. All right, that's Vikram Solar with the perspective on the business and, of course, the offering which is coming through. I mean, lots of stuff added to the list in terms of what's moving. I think Vardhman Textiles is up 7%. Vardhman Textiles is coming up at about 440 rupees. It's a big one, which is showing up right now. And of course, the others we've been mentioning, earlier as well. Ola still remains up 5, and so on and so forth. So,
and the one that's come out of the F&O ban as well.
PNB Housing.
PNB Housing Finance. Last half hour of trade yesterday, I said this, right? That going by the looks of it, last 30 minutes, but it appears set to come out of the F&O ban. Remember, there were lots of shorts in the system. The stock has seen a big correction post that resignation at the top. Now all eyes on the new CEO that's coming in there. And valuation-wise, it trades at around less than 1 times price to book after this sharp correction. So that's one of the big movers this morning, up 2.5%. The other one I'm going to look at now is PG because in the next 2 days, that could possibly come out of the F&O ban as well. Let's get in Mitesh Thakkar. Mitesh, mild green to start off trade. The Nifty Bank underperforming yet again. Your view on the index and 2 stocks that you have for us?
So, one, I think, the opening is slightly better than expected, but the other thing is that the structure remains positive despite the fact that the Bank Nifty is mildly negative and Nifty is practically flat. So I would maintain a positive stance. Disclaimer that we have today initiated some bull call spreads on the Bank Nifty. And waiting in case we get Nifty closer to about 24,850, 820 zones, we'll add similar positions on the Nifty as well. So in that sense, it's a positive outlook. On the stock side, I think it's the telecom names which are very strong, Reliance and Bharti Airtel. Reliance is a buy with the stock below 1395 for targets of 14 plus. And Bharti, I think, I'm waiting for the stock to clear today's high, which is around 1932, 33. That's the pivot. Once it crosses that, buy with a stop at 1915 and look for targets of 1965.
Okay, all right. Thanks very much for that, Mitesh. Those are individual trades coming through. It's past 10. We'll take a quick commercial break here. Manisha will be joining us with what's top of mind for her as far as commodities go. Stay tuned. Okay, welcome back. Let's shift focus to the commodity space. Manisha is here with what is top of mind for her. Manisha, good morning.
Morning, Prashant. Thank you for that. Well, I'm looking at cotton prices right now, where the international markets actually have seen some bit of a decline continuing there. When you look at this year, we are down by 3% in the global markets as far as cotton goes. For the Indian markets, overnight was a notification that came in from the ministry and the regulators, where government has scrapped levy on cotton imports, and this is until 30th of September. This is from 19th of August starting today. So this is basically for these 42 days only. 11% duty has been on cotton imports, which totally has been done away with. Markets clearly cheering this up, as you have yarn, fabric, apparel industry actually showing a thumbs up on this. Remember, when you look at the international markets, we are slightly not competitive when it comes to exports, but the international prices have been on the lower side, and with the 11% duty done away with, it would be cheaper imports that would be coming in India. These are the kind of numbers that we anyways have been doing in sense of imports of cotton. So 23-24 was 15.2 lakh bales of imports that India saw. Last year was a record import at 39 lakh bales. This is because the international markets were trading cheaper. India has had a lower sowing, lower crop as well, and much of those imports really came in because of that. Now with the 11% duty also done away with, we are anticipating that you could be looking at higher imports at least for the next 45 days, 42 days that is, until the time that you have this temporary import duty done away with. Interestingly, also, when you look at the India's sowing, cotton, remember, is a kharif crop. So we've seen sowing happen in the months of June and July, and the arrivals start coming in the months of October to Feb, that is. So area under cotton cultivation has seen a decline as compared to previous year. Last year was 11.04. This year is 10.69 million hectares therein. Also, what India has a target from the Commerce Ministry is exports of textile to the tune of $100 billion by 2030. Now, industry has been telling me that this is achievable only if we are competitive in the market. Now, with the kind of tariffs that we have, especially from US, which also is a stronger market for us, we stand at around 50% after 27th of August if nothing changes. In the meanwhile, you have our peers or competitors like Bangladesh and Vietnam looking at 20%, Cambodia at 19%, even China for that matter is lower at around 30%. So India really looking at means and ways of ensuring that exports do not get hit. Further cheaper imports would ensure that our profitability and India industry margins improve and the export in that sense become profitable or at least competitive with the kind of tariffs that we seem to be facing.
Okay, all right. Thanks a lot for that, Manisha. Well, let's stick with commodities then. I'm looking at Vedanta today. The street is clearly excited because they're going to be meeting on the 21st of August to consider an interim dividend. The record date for that particular dividend will be 27th of August. Remember, just, in the first quarter, they had approved a dividend of close to around 7 rupees. So that's a dividend-paying machine. The street likes it. What happens when they pay dividend is the promoter's in better shape because he can repay some of the debts. That's Vedanta Resources. And for shareholders as well, they receive the dividend. So the street likes it. Also, all eyes are on the NCLT hearing. That will take a call with regard to that demerger. So both those two triggers, dividend as well as demerger moving forward. That's being tracked by the street. Stock up 2.5%. Well, time to slip into a quick break. On the other side, our special segment, It's the Economy. Lata talks to Samran Chakraborty of City India as well as Soumyakanti Ghosh of SBI. Stay with us.
Welcome. It's the economy. The equity markets cheer over the twin good news of S&P upgrade and promise of GST cuts looks like lasted only for a day. The bond yields have done worse. Yields fell on Thursday after the rating upgrade. They fell to as low as 6.42% from 6.5%. But currently, today, they stand at 6.51%, a 10 basis point increase almost. This is the highest level since April 9, which means not only the rating upgrade, but even the 50 basis point repo cut of June is being ignored by the bond markets. Clearly, the market is worried that the centre and definitely the states may borrow more this year than budgeted, which means at the moment, the bond markets don't think the economy will grow fast enough to give more tax revenues to the government. To get a 360-degree perspective of the economy, the fiscal deficit, inflation, interest rates, I have with me two pre-eminent economists, Soumya Gandhi Ghosh, Chief Economic Advisor of State Bank and Finance Commission member, and Samiran Chakrabarti, Chief Economist, Citi India. Gentlemen, thank you very much indeed for your time. And a bigger thank you to you, Soumya Gandhi Ghosh. Soumya has just come out of the, yesterday evening from the government meeting with economists and landed at 3 a.m. in the morning in Mumbai. So deeply grateful to you, Soumya. Well, for starters, what is the sense you are getting? Is the bond markets worry that the fisc is going to be stretched, that there may be even extra borrowing from the states and centre? Legitimate fear?
Yeah, thank you, Lata, and thank you for the nice introduction. If you just give me 2 minutes, I'll just explain. I think, yes, there are two sides to the story. The first is the potential revenue loss is going to happen because of this GST rationalization. I think there is various estimates in the market, but we think that the revenue loss actually is it's two sides of a coin. On the one side, you will lose the revenue. On the other side, you will gain the revenue because you are moving 28% to 40% some of the goods. So from there will be an equal share distribution with the center and the states. So in the end, the revenue loss could be anywhere between 1 trillion or so for a full year. So that means for the next 6 months, it could be around 50,000 crore. So obviously the fears of the bond market is that whether this 50,000 crores will be, or this 1 lakh crore or whatever is the amount will be able to be adjusted by the center in its fiscal numbers. Our sense, we believe that I think there is a deeper aspect of the story. As you know that the compensation cess has ended, but the center has given back-to-back loans to the states, with the states now repaying. And this year already around 6,000 crore has been repaid. Around 49,000 crores will be repaid in November 2025. And next year, April, I think the entire amount of 130 trillion will go out. So the entire repayment will be made. So and there is also an amount which is lying in the compensation cess.
Okay.
The estimate could be closer to this 50,000 crore number. Okay. So our sense is that in the overall analysis, the revenue loss could be compensated significantly by this compensation cess, because the states will now be free, because this money will not be deducted from the states because they will not be repaid to repay the amount. So
Got it. So your math is suggesting is that the bond markets is probably worrying in vain. That, for this year itself, it's only going to be probably 50,000 crore shared by centre and states. Part of them could be met for the centre at least from the excess money lying in the compensation cess. Samiran, this math, I'm not hearing it first from Soumya. Something akin to it is available in the market. It is floating, though not so precisely. Then why is the market behaving the way it is behaving? What is its worry?
So thanks, Lata. I think I almost entirely agree with Soumya on this. To start with, the way I put it is that tax is a zero-sum game. So if whatever amount the consumers are going to gain, it is going to be exactly the same amount, which will be a revenue loss for the government. But for us analysts to estimate that amount, which will be the gain for the consumer or for the loss for the government, is very difficult because of at least 3 reasons. One reason is that we do not know how much is going to be the pass-through of these tax cuts to actual prices. GST is an ad valorem tax, so we might not see the entire reduction in revenue because the companies might not pass on the entire price cut. The second is obviously the Laffer curve argument that actually economic activity, consumption might improve because of tax cuts, and that will lead to higher revenues. So there are multiple such things which are very difficult to estimate at this point of time, including something like input tax credit. So whatever number we are working with right now, there is a considerable band of uncertainty around it. I think the market is reacting to that uncertainty.
Okay.
That confidence that was there in the market, that fiscal deficit will definitely be met at 4.4%. In fact, could be slightly better because of higher RBI dividend and a higher nominal GDP number. That optimism might have got a hit, and that's probably the reaction that we were seeing.
Okay. Soumya, since you are freshly landed from the capital, one of the guesses of the market could be that there is a fiscal package coming for exporters. Surprisingly, today, all the textile stocks are doing well, actually, or many of them are doing well. Is there a chance that something will be designed for those who are impacted? You see, the data is there with the government. Who exported what to the US last year? And therefore, to compensate them for the extra penal 25% is not methodologically difficult. Will that be a course the government may take?
No, I think there, as I have understood in the media, I think there are something which is being worked out in terms of a compensation structure for the exporters. So what form it will take, it is a little difficult and tag to say at this point of time, because again, it is uncertain. We don't know when the trade deal is going to materialize, whether this 50% will stay from the end of August till this September when the Prime Minister visits the US. So basically the trade deal could culminate at the end of September when the Prime Minister visits the US. That also is an uncertainty. So my sense is that, yes, there is some package which the government is thinking about, but the government is also in a wait and watch mode to see what will be the impact, because already reports suggest that August exports have been significantly front-loaded. So maybe if we can pass through this period of August, there will be another month of uncertainty. So maybe all these options the government will look into, but there is obviously an option of looking into a package for the exporters, specifically the textile, gems and jewelry, made-in products and others, which is a significant share of exports to the US market.
Oh, yes, marine, very big. I mean, the shrimp exporters are practically entirely dependent on the US. And for what it is worth, the state of Andhra is a political ally of the centre. I mean, they may help even otherwise, but that's also a point. Samiran, I went through your note. You are saying that there is a 0.6 to 0.7 benefit or percentage of GDP benefit because of all the cuts, the income tax cut, the GST cut, etc. Will all this be taken away if it is 50%? And are we working with a flat GDP? You have not given the negative, obviously, because there is uncertainty. But what is your ballpark guess?
So we were partly anticipating this stimulus of about 0.7 to 0.8% of GDP, including the income tax cut, the GST cut, as well as the interest rate cut. On top of it, there could be some additional coming out of higher credit growth if it materializes. So ballpark, let's say about 1% of GDP is the stimulus towards the households. Now, one question is how much of this stimulus is going to be spent versus saved? And that is more a function of consumer sentiment, which in turn could be impacted by the wealth effect coming out of asset prices. As of now, the asset prices have been pretty flattish, which is why probably the consumer sentiment is somewhat weak. And that's why we are not yet seeing the larger part of the stimulus being spent rather than saved. But on top of it, we have this headwind of how much fraction of the GDP I should take out because of the higher than expected tariffs. At this moment, it's so fluid that we haven't been very precise in that estimate. We have put it in the form of sensitivity that at 25% tariff, it's still about 0.3 to 0.6% of GDP is a sensitivity. However, our estimate has on growth for FY26 has always been a notch higher than the official estimates from RBI, because we thought that because of some statistical reasons in the first half, as well as the stimulus impacting in the second half, we should see a slightly higher growth this year than what the current estimates are. So we are slightly ahead of the street on this.
Okay. You know, another factor which we are not discussing, but the stock market is giving us some signs. L&T did not rise. Yesterday, there was a 1%, at one point, even 1.5% gain in the markets. It was all consumption stocks. Capex was clearly sulking. Soumya, should we worry that, the capex expenditure might soften, and definitely in the states, if not in the center, because they are likely to be hit more by the GST?
Yeah, I think, Lata, that's a possibility, because capital expenditure at 3.1% of GDP at 11 trillion in the budget, I think has already reached its peak. But you also need to understand that there is an grants which the center gives to the states as a part of the overall larger fiscal architecture, which is around, I think, which adds to around 1.2% of GDP. So my sense is that as long as these grants continue, this creation of capital assets will continue in the states. And the states have also been given this 50-year interest-free loan, capital expenditure by the center, which has been used quite well by the center. Of course, there are conditionalities. So my sense is there will be some impact on the capital expenditure. Obviously, it has peaked and it cannot go any further higher from over there. But again, I think it's a matter of debate how much the hit will be, because the evidence on this is still forthcoming.
Okay. All right. Okay, I'm being hounded that I'm running out of time. So 2 quick questions. Same question to both of you. Samiran, does the CPI fall even further because the GST will bring down prices of some things? What are your rate cut forecasts now? 1 more cut, 2 more cuts?
Lata, it's difficult to give you a precise number on CPI because we do not know what the pass-through for the companies are going to be. But 11 to 12% of the CPI basket is likely to be impacted positively by the GST cut, with medicines and apparel being the largest components within that is what our sense is. Not putting in another fresh rate cut right now, because it seems like the RBI is looking at the forward-looking inflation number, which still remains quite elevated.
Okay. Soumya, bringing down inflation, are you? Rate cut expectation?
I think if we assume that there is a full pass-through, the impact on CPI could be as much as 45 basis points, 40 to 45. But even if there is a 50% pass-through, I think their impact would be around 25 basis points or so. So I think there will be obviously an impact on the headline inflation. But the important thing is that at this point of time, again, we are not building it any rate cut by the RBI, and we believe that the RBI will wait and watch the next year's CPI new base, these new numbers. So they will see through to see what will be the impact on the headlines. Yeah.
Okay, that may be the other reason why the bond market is not reacting. Okay, I want to invite both of you again to look at the new Gen Next reforms that the government is contemplating. But since it is just on the cards, we will postpone that for the next time we meet. Thank you very much, Samiran and Soumya, for improving our understanding of the macros. We wrap up on Bazaar Chartbusters coming up.